Lynn says, "Hi, Austin and Robert. I'm a new listener in my 60s and love all of this valuable information. I'm getting ready to retire next year at 67 years old. I will have a great pension from a large company, and I also have about $400,000 in 401ks and Roth IRAs, $150,000 in brokerage accounts, $100,000 in crypto assets, $80,000 in a high yield savings, as well as some CDs. The pension and Social Security I will get will provide about 90% of my current income, which gives me a pretty nice living in retirement. However, I'm also starting to lean towards more high risk investments." On last week's episode, Andrew's question about high-risk investing was interesting to me, specifically talking about leveraged ETFs and how to capture more upside using them. My question is, are these ETFs generating monthly income by selling or writing options on the stocks? I'm not sure how these ETFs work and how they're able to multiply both the upside and the downside of the price action with the underlying stocks or indices they track. This is a really good question. Robert, you want to kick us off?
Yeah, I'll kick it off by saying that make sure that everyone listening and following along does their research. It sounds great when it's promoted to you and it's a 3x multiple. So if it makes 8% and it's 3 times leverage, you're going to make a 24% return. But that rubs both ways. So remember, in these leverage ETFs, and it's why I don't use them or promote them, you're going to have the same multiple of downside risk as well. So make sure you understand that, especially in volatile markets, because it all sounds good if we feel like we're safe enough in a long running bull run. But right now, I just don't think it's a really good strategy. I think there's better ways to find higher risk. Austin and I believe that you should always have a high risk bucket, but I don't think this is the way I would go about it. I would rather see taking some of that money and marking it for private investments, pre-IPO investments, maybe some real estate and multifamily. Some of those things may be a little more high risk to balance out your portfolio without being in the predicament of what I believe is a bad idea for these highly leveraged ETFs.
Yeah, I just want to make sure Lynn listening here completely understands how these ETFs work, right? So for example, UPRO is a very popular one. It's the ProShares Ultra Pro S&P 500 ETF. And according to their website, they offer a daily 3x leverage to the upside or the downside on the performance of the S&P 500, which means that any given day, if the S&P 500 is up 1%, this ETF will be up 3%. Just as if it's down 1%, this ETF will be down 3%. And year to date, the S&P 500 is down about 6 or 7%, and this ETF is down 25.5%, right? So like if you're on the wrong side of one of these sort of leveraged trades, you can absolutely blow things up in your portfolio. So what I want to encourage you to do, Lynn, is maybe take a step back from this. I understand that you want to do some high risk investing. I'd encourage you to listen to Robert's advice about different asset classes versus using leverage to multiply your returns or your losses depending on what you're trying to buy in the stock market. I don't own any leveraged ETFs. They just, to me, don't make a lot of sense. It's very much timing the markets, and I'm not very good at that, to be honest with you. So it's something I'm staying away from. But Zaid, what's your perspective on leveraged ETFs and things of that nature?
Totally agree with everything you guys are saying. I do want to add about these leveraged ETFs. So I'm not a leveraged ETF guy myself, just like you guys. These leveraged ETFs are designed to track the daily movements of whether the S&P or they have like these leveraged ETFs that track individual stocks as well. So it's not a buy and hold instrument either. So like there's decay over time. I think Austin, you mentioned that the S&P example, the S&P is down 4% this year, but this leveraged ETF is down 24%. So these leverage ETFs are designed to be a day trader instrument. So unless you want to do that and day trade with these leverage ETFs, which again I don't recommend either, it's just hard to recommend these to anybody. They're too volatile, they're too risky, the decay is there. You got to be trading these hourly essentially to take advantage of the volatility. There are better options out there that Robert just mentioned. So you got to understand how these leverage ETFs work and just don't get caught up in the viral TikTok video or whatever that someone's like, oh, I made 300x because of this leverage ETF on, NVIDIA or something. Got to be very careful with this stuff, and the decays and stuff behind these instruments can have a huge impact on returns.
Yeah, I totally agree. And it always comes down to this. As you're building your wealth, personal finance is personal, but you don't have to get fancy. I'm very wealthy. I'm here every single day sharing my journey, and I don't do fancy stuff. I understand what I'm investing in. I'm a long-term investor, and I suggest all of you watching and listening do the same, because when you try to cut corners and be real fancy to make more money, it usually doesn't work. And, Austin and I's message is pretty straightforward for the last few years you've been following. And that is, be a long-term investor, understand what you're investing in, and just stay consistent. And I think that's the big takeaway for this question.